Welcome back to Talking Points, where like-minded entrepreneurs and investors get together to talk about investments and opportunities, and we drill down to the detail of what is most important to investors. Now, one of the core focus points of any investment is, of course, property. And the reason why is it's proven time and time again to be one of the most reliable and successful investments. But the important thing is to make sure that you get it right from the beginning. Now, today's topic is no different. We are looking at the foundations of what you want to achieve from your portfolio. And to talk on this point a little bit more, I've invited our resident property expert, Emile Grobbelaar, to join us. So Emile, thank you so much for joining us again today.
Hello, Damien. Thank you. It's always a pleasure.
Now, last week you published an article aiming at helping people understand what their goal would be to create an investment portfolio. Now, Emile, based on your experience, what are the current methods that you see people following to invest in properties and to start portfolios? And are there any flaws within those methods that you want to raise with us today?
Damien, yes. I find that a lot of people know that investment in property is good. They don't always know what to do and what is the best way to go about it. So the things that they do wrong when they decide to go that route is obviously firstly not making sure and finding out all the information, and then they go out and buy the wrong property. Now that there's a few things to it, the wrong type, the wrong area, the wrong price, especially for an investor. The price is wrong. Your return is not good enough. If it's the wrong type of property, it's not rentable. If it's the wrong area, the demand is too low. So that's one of the big mistakes they make. And then secondly is ownership of an investment portfolio. The Wealth Masters way, it needs to be in a trust. So what they do is they buy it in their personal name, and that is definitely the most wrong way to do it. Some people put it in company, halfway wrong, if I can call it that. It's not always wrong, but either in trust or in company is much better than buying it in your personal name.
Now, there's also a general perception, especially amongst millennials or people my age, that you need to have large sums of capital in your bank account to purchase your first property portfolio or to start a property portfolio. Is this the case in reality?
Second-hand property, then you definitely need cash. Even if you get 100% bond, you will still need to pay the registration costs of the property. And if you have the bond, then the registration cost of the bond as well. Now, dependent on the price of the property and the value of the bond, that will determine how much money you need. And it can be a lot, 50, 60, 80, 100, 200,000. You buy something above 1.5 million, it's much more than that. So I would suggest, for somebody that wants to start off, doesn't have a lot of capital available, buy a new development. Most of the time, all costs, registration and bond costs, are included in that price. So it will assist you. And if it's your first property, chances are very good that you will get 100% bond from the banks. It does differ between a trust, if you buy in trust, and if you buy in your personal name. The banks tend to give 100% bonds much easier to people buying in their personal names rather than trust. But if it is your first property, and even if you buy it in trust, chances are good that you will get 100% bond. So that is the way to go about it if you don't have a lot of cash. If you have a little bit of cash, hold onto that cash, keep it as a kitty for that first property or first couple of properties, that you can cover things that needs to be covered if you own that property. So definitely you don't need cash, or a lot of cash at least. 100% bonds in new developments where costs are included. That is the way to go if you want to start off.
And Emile, what would you say is the first thing someone should consider when they're looking at starting an investment property portfolio?
Well, first of all, affordability to get a bond. If it is an investment, you want to borrow as much money as possible. But once again, you need to balance it out with your cash flow on a monthly basis as well. So affordability will determine whether you can start or not. But I would say you need to decide what would be your first and second and third property. The types that we have spoken about previously as well are the cash flow positive properties, and then your refinance type properties, which at this stage we buy a lot more refinance type properties that gives you a lot of capital growth because the interest rates are low. But as interest rates go up, you will have a negative cash flow there. So you need to decide, what will be my first property? Can I carry a shortfall in a month? Then you go out and buy the high capital growth properties to refinance as early as possible, or rather buy a property that gives you positive cash flow. So that is decision number one on your property number one to start off with.
Super. Now let's just consider the four main property strategies that you spoke about in your article, namely number one, building a rental portfolio. Number two, buy, renovate, and sell. Number three, developing existing properties. And number four, buying land, subdividing, and building. Now, on the build to rent portfolio, or building a rental portfolio, I beg your pardon, what are the risks involved and what would be the cost to consider?
Damien, the risk in that portfolio is purely on the rental side, vacant property, in other words. So when you do have vacant property, all costs, i.e. bond, levies, rates, need to come out of your pocket. The rental market, well, a little bit up and down the past few years, and Cape Town is a lot stronger than areas like Gauteng or even KZN. So the risks are that you have a vacant property and you need to carry the cost out of your pocket. Other than that, if you buy the right at the right price, of course, and your return on investment is good enough, your risk should be mitigated. The right property will always be rented.
And Emile, on this rental portfolio, how much time or effort would be required from the investor to manage a portfolio of this type?
If the investor decide to manage it themselves, I would say, maybe up to a point of 2 or 3 properties. It could easily do it themselves, but maybe through an automated invoicing system like TPN that can assist him with that. The big problem with that is placing tenants. First of all, if you don't have the experience, you will definitely place the wrong person, and that will put you in trouble. People that won't pay rent, people that won't move out when they're supposed to. So it puts you at risk. It gives you a lot of cost to evict them eventually. So even if you manage your properties yourselves, pass that on to the professionals. Just employ an estate agent to do the placement and do the proper vetting of the person that you place. Thereafter, 1, 2, or 3 properties won't take up a lot of your time. It is usually just the invoicing that goes out. Make sure that you charge them for whatever services are not on prepaid, and make sure that the money comes in. But once you go past 3 properties, then it's going to take up a lot more of your time. Keep updated with contracts that have to be renewed. You need to do the maintenance. Obviously, with more properties, there's more maintenance, more issues from the tenants as well. And then I would certainly pass it on to the professionals. So I won't carry on doing it myself if I have another job past 3 or 4 properties in a portfolio.
And now, Emile, talking a little bit about the buy, renovating, and sell, I think one of the biggest misconceptions that I've seen with people who are flipping properties is where they buy, they renovate at their risk, and then they sell and then count the profits. And I think the reality there is that not a lot of people take into consideration all the taxes that have to be paid on that profit that they make. So what are your thoughts and opinions on this kind of strategy, and how much time is involved with a project such as this?
Damien, that strategy is purely for cash. You're not building a portfolio. You're not building up something that you can leave for your children to take over eventually. You're not building up something that you can live off later on. So yeah, that is not what we do at Wealth Masters. We like to build up portfolios, hold on to property, and leave it in trust to our children. If you do this type of business, you're a trader. You're not an investor. Profits on taxes rather on profit, very heavy, capital gains tax. That type of business is also very cash heavy. In other words, you can buy the property, you can perhaps finance that, but you can't necessarily finance the renovations that needs to be done. So you need to put that cash in out of your own pocket. Now, that is very risky. You don't always know what you are buying. It could cost you more than what you initially anticipated. If you buy something like that and there are even people inside, because the cheaper type of property that you buy and can renovate is run down, usually distressed sale. So you might sit even with people inside that you need to evict firstly. So it's a tough business. That if you renovate and you have to work with people, it's very time consuming. You as the person who owns the property will probably need to keep an eye on it yourselves, and that will take a lot of time. The people work from 7, 8 o'clock in the morning till 5, 6 tonight. So you either need to be there 60, 70% of the time or 100% of the time. It's very time consuming.
Now, talking about existing properties where you buy a land and you develop, it obviously seems like quite an exciting thing to do, but there are many things that you need to be cautious of with the strategy, of course. Can you tell us a little bit more about the risks involved in that sort of a strategy?
Damien, that is a very nice strategy for cash flow. And as long as you have the property and convert things like garages or outbuildings, it's a lot easier. But as soon as you start adding onto a property, you have the house there, there's a lot of space on the property where you can build 3, 4, 5, 6 apartments. Now then it becomes a lot more complicated. First of all, you need to draw plans. It need to be approved by council, and they will only approve it if it is within the building regulations of the suburb or even the property. That could make things difficult, but they are not against high density living, mostly in South Africa. So chances are you will be able to do it. But once again, you need to have knowledge of construction. You need to work with people. You need to employ a professional person. It is costly, but the return is very, very good. It definitely increases the value of your property, but the risk there is that you invest too much. You over invest in the property, so the value goes above market value. If you do decide to sell at some other stage, then you probably won't get your money back if you don't keep an eye on that. But if you do business like we do in building a portfolio, we won't sell it. We'll just keep and count the money. It's very, very heavy cash flow positive properties, those.
I'm sure everybody loves to count the money. Now, Emile, last question from me. What is the most important piece of advice that you can give interested investors who want to start a property portfolio?
Well, I would say consult with a professional. Consult with financial people regarding the financing of the property, also future planning on properties, especially if you want to do it the way that we do it, in keeping property at risk. In other words, keep on refinancing. In other words, there's always a bond on the property. So that is a very, very big risk. So you need to work with people, at least get advice from people that knows that type of business. If you have positive cash flow properties and you pay off the bond, there's no risk. You remove the risk as soon as the debt is removed. But when you want to start off, and if you're young and you have not done a little bit of reading or at least attended some courses with people like the Wealth Masters that can tell you a little bit of how to do it, then you're going about it the wrong way. Invest in a little bit of knowledge, talk to people that can give you advice before you start. One thing, at least, property is very patient. If you do make a mistake, it takes a long time before it really bites you badly. So you have time to rectify it as well. But the best would be just to talk to people like the people at Wealth Masters that can help you to start off. Even if you don't qualify for a bond right now, we can advise you on save up a bit of money, what you need to do to qualify eventually. And all of that will help you to start the right way and not make a mistake. And then obviously thereafter, things should go much, much easier for yourselves.
Fantastic. Emile, thank you so much again for your time and valuable insight. Now, for the people listening at home, if you'd like to learn more about how you can also plan for the start of your property portfolio, then join us this weekend as we share some insights into how you can start a portfolio using other people's time, skills, and money. Now, to register, simply click on the link below in the description over here and register. It's absolutely free. Our goal is to share as much knowledge as we can to help you become an informed investor and to go against what you may have been taught in the past, because we are opening new doors and new avenues for what can be done. So Emile, once again, thank you so much for joining us. We really appreciate it. And we will see everyone again next week. Bye-bye.